You can make life-changing money by buying just one wonderful business. You can buy one wonderful business and transform your life and the life of your family forever, right? You buy a business that generates 1 million of free cash, or maybe it does 500K, you grow it to 1 million. If it predictably does 1 million of free cash for you for 15 years, that's a beautiful outcome.
Welcome back to another episode of Our Future Podcast. I'm your host, Simran Sandhu. I'm joined by my co-founder and co-host, Michael Sakan, and this is the go-to entrepreneurship show for young people. We give you the tactics, strategies, and insights that other young people have used to win in business. And today, we're super excited because we got a special guest joining with us. His name is Sieva Kozinsky, and he's a man of many different skills. He started his first business, grew to over 1 million users, realized that, the inspo of what Warren Buffett was doing and what Berkshire Hathaway was doing was really, really interesting. Started his firm, Enduring Ventures, and they have been crushing it. It's been over 5 years since they've started that firm, and now they run and manage over 17 different businesses. So, Sieva, super stoked to have you on the pod.
Simmy, great to be here. Good to see you.
So the way we like to start this pod is we love to get a sense of your entrepreneurship journey. Before we recorded, we were talking a little bit about, what one of our mentors, Sam Parr, had told us about you guys meeting really early on in the Bay Area. But tell us a little bit about what your journey was like post-college and how you got into business.
Sure. So I started my career thinking I was going to be a doctor. So in college, I was taking pre-med classes. I'm the son of Soviet Jews, so they were pressuring me to be some sort of doctor, engineer, lawyer. I'm sure you've heard some of that story before from others. And I was on that path. I was taking my pre-med classes in college, and I just kind of stumbled into an entrepreneurship class on campus. Some of my good friends had taken this class. They said, "Hey, I think you'll get a kick out of it. I think it's the best class on campus. You should check it out." So I signed up. It was an elective class that you had to pay for, or pay for over and above the tuition. And it was taught by this guy named John Greathouse. He was an entrepreneur that was very successful in multiple different businesses. And now he was kind of retired and just teaching this class to, hopefully educate and inspire a future generation of entrepreneurs. And he really did just that for me. I had never once considered starting a business. I don't have anyone in my family that's an entrepreneur. I'd never really heard about it. I come from a family of healthcare professionals and dentists. And he would kind of stand up in front of the class and tell his stories of how he founded a business and how he hired a sales team and how he raised capital. And then he would invite his friends who were also successful entrepreneurs to do the same. And I was fired up. I thought it was so interesting. I really didn't care for academia before. My biology classes were boring. My chemistry classes were boring. Not that they are boring. It's just it wasn't a fit for me. But this entrepreneurship class was incredible. I was fired up. I was thinking of business ideas for the first time. And that's how I stumbled into my first business, which was really an education tool for college kids. So at first, we tried to create a course delivery solution. We worked on that business for 1.5 years. This is while I was still in college. That business did not work out for me. I learned a ton, but it was very painful to grow. And then we pivoted to this note sharing and peer-to-peer tutoring business, and that really had legs, and it started to take off. And then we raised a little bit of capital, grew that business to about 100 different campuses nationwide. It was never a very big business. We had a lot of users. We had over 1 million people a month using one of our free tools. But it never became a venture scale business, which was really the intent when we started that company. Eventually, I decided that I wanted to move on and work on other things. My business partner continued building that company. And then I started a clinical trial business, basically running phase 2 and phase 3 clinical trials for drug companies, mostly in dermatology. Yeah, it was a little bit left field. And it was not a non-tech business, right? I went from running this tech business that was not profitable, that was burning money, to this service business that was extremely profitable and had a really healthy gross margin to it. It was just a good business model overall. And then I sold that business, started a venture capital firm right around the same time, spent a few years in VC. Didn't love that. We can always talk about that later. It just really wasn't a personality fit for me. That fund is still around. The funds 1 and Fund 2 that I was involved with ended up doing really well, or are currently doing really well. And then I started my current business, which is Enduring Ventures. We are a long-term holding company. What that really means is we're in the business of private equity. We buy businesses. We like to hold them for the long term. We like to grow them. And like you said, today we have a portfolio of about 20 companies across a variety of different sectors, including HVAC and swimming pool construction and software. We have a hotel management business and a few other categories we can talk about.
So how did that clinical trials business work? Like, what is it? They're giving some like young kid like the ability to run clinical trials for like humans, like rats, like, and tell me more about how you schemed your way into that, because that's like a really good hustler story.
Sure. Yeah, I schemed your way is probably the right definition of what happened there. Basically, I was fascinated by, like, if you zoom out a little bit, I was fascinated at the time by these companies like 23andMe and Ancestry.com. They had raised hundreds of millions of dollars around this concept that we're going to sell DNA kits to people. Then they're going to send us their DNA. We're going to store it. And one day we're going to be able to graft their entire genome, basically. And we're going to be able to make deductions based on that data to inform better drugs. And we don't really even know what, but really the end goal is to inform better drugs and drug production in order to help people with whatever diseases or complications they may have. So I thought that was fascinating. I remember hearing at the time that 23andMe only had 5 million samples of people's DNA. And I thought to myself, wow, I could go raise money. I could go get a bunch of different samples from people. And I think I could compete with these guys pretty quickly here. That idea led me to explore pharma in general, right? I was starting to connect the dots. Okay, 23andMe is interesting. It's valued for a lot of money. Why is it valued for a lot of money? Oh, because they're planning on selling data to pharma. Okay, then I started looking at pharma. So what is pharma's biggest problems, right? This is a huge industry. They talk about it in the news all the time, right? Billions of dollars spent on drug production. People are always complaining about how drugs are too expensive. So I started looking into that. Why are drugs so expensive? The very simple methodology of getting a drug approved for human use is basically you come up with the idea, you test the compounds. When the compounds work, you create the drug. When the drug works, you go to phase 1 clinical trials, right? This is to get through FDA approval. If nobody dies, right? If everyone is safe, then you can go to phase 2 and then you can go to phase 3, which just means you are recruiting thousands of patients to test this drug that you're monitoring over a period of time. What I learned digging into this whole process is that half of what they call drug production budget, when they say it cost $1 billion to get this drug to market, in many instances, it was $500 million to do the research and produce the drug, maybe do the marketing. The other $500 million was to recruit the patients and to run the clinical trial, phase 1, phase 2, phase 3. And that was kind of like a light bulb going off in my head, right? I said, there's this huge market, there's this huge problem that pharma is paying a lot of money for. What's going on? And at its core, what was going on and what is going on is it's really hard to recruit patients for the specific problem set that you're trying to solve, right? Let's say you have a special type of breast cancer that doesn't have any solutions yet in the market. Well, you have to look for those patients nationwide, and then you need them to come to a university so you can run the trials. So my very simple solution was, I'm going to bring the trials to the people. I'm going to run the trials in their local offices. So I partnered with the doctors in order to run clinical trials right in their offices for those drug companies. And it started taking off really nicely, and I ended up selling that business to another group that was doing something similar.
Sieva, you're talking my language. In a previous life, I used to work at Eli Lilly, so I'm very well versed in all of this good stuff. But I think it's great that you found a way to make a business out of it. Tell me this, like, one, I'm very curious about the mindset shift from going from, hey, I'm going to go build a venture-backed business and we're going to go take the market and we're going to go build this truly like multi-billion-dollar company, or at least that's the mindset for a lot of people in the Bay who are very young and ambitious, to then going, you know what, like I want a high probability win. I want to go build a business that can cash flow maybe, millions of dollars, be really big, it's sustainable, it's not as flashy, but it can be a true business and maybe you have a little bit more control over your destiny.
Yeah, it is a huge mindset shift, and it's one that I had to go through as well, right? Because my first exciting addiction was building a wonderful company, right? A big company, a VC-backed company. And frankly, the reason that is because I grew up in San Francisco and I was surrounded by other tech founders and I was reading TechCrunch. And in my mind, I was like, wow, these guys are the rock stars of industry, right? Like I want to be a rock star of industry. And, 21-year-old Sieva was easily attracted like a moth to the light to this excitement, right? And I thought to myself, okay, like to matter in this world, to do something important, I need to raise VC because then I can build a really big company. If I build a big company, I can have massive impact. And I tried that. It didn't work for me in the sense that like my business didn't die, but it also didn't become a VC scale Airbnb. Yeah. And what I learned is that the probability of that outcome is so low that it almost doesn't make sense to even do it, to even try it. For most people, it just doesn't make sense. And I think a lot more people are drawn like moths to the light, the same way that I was, to this idea of like doing something big and having a brand name VC involved with you and feeling like you're really important, and all these things. Like I frankly got caught up in all these things that actually maybe don't matter when I like took a step back and I thought to myself, what is important in my life? In Silicon Valley, it is poo-pooed basically to have a business that generates $1 million of free cash. If you're hanging out in San Francisco and you're like, oh wow, I have this media business, it's been generating $1 million of free cash for the last few years, I own 90% of it, we're having a good time running it. People are like, what are you even doing? Like, why are you here? Why don't you build something that like matters? And the reality of it is like, if you have a business that's generating $1 million of free cash, like you can live an incredible life. You can provide an incredible life for your family. You can donate money. You can buy a house. You can feel like very stable with your financial situation and your family's financial situation. And when you have that stability and that comfort of mind, you can go out and build other things, right? You can do another venture scale thing once you have your bases covered. So I think there's too many people that are in VC that don't have their basics covered, their basic financial outcomes covered, that are chasing this dream that has a low probability of outcome. But it's a huge mindset shift, and it's definitely one that I had to practice.
I'm very curious. So going back to the trial business, that business is doing really well. You sold it. And where did that inspiration come from to say, hey, I want to find maybe a repeatable or scalable model, or I'm trying to get into several kinds of these businesses. And like, was that kind of the cliche kind of, I came across a Warren Buffett book and like learned everything there was about investing. And I realized like there's an opportunity to go do this. Like, what was your story like there?
Yeah, I've definitely been iterating as I go, just learning on the go. I've crashed through like a lot of walls, running at full speed, and I just kind of dust it off and then I move forward. So I had my little education business. I had a business partner there. I raised some angel and VC capital for that business with the intent to go big. It was not profitable. My next business, I had no business partners. I did it by myself, so I owned 100% of the downside and 100% of the upside. I didn't bring any investors. I personally put in a little bit of capital and I got it going, and it was profitable from day one. And I had a good path to continue growing it. My third business after that is Enduring Ventures, and that's really the company that I intend to do forever. And it's a learning from everything that I've done to date, right? So how was I inspired to do it? One, through those experiences. Two, like you said, I read a Warren Buffett book. It's a cliche. It just happens. So I read the Warren Buffett book when I was running my education business, which is called Study Soup. I'm running this business. It's not really profitable. And I'm reading about Warren, and he has all of these profitable businesses, some of which aren't growing. They just produce free cash, some of which are growing. And he's shuffling money from the ones that aren't growing to the ones that can grow. And I'm thinking to myself, I have this one business. It's a little profitable now, but it's not the best business. Like I can't put more money into it. It won't grow. I wish I had other businesses that I could put my money into. And I kind of just filed that away into the memory bank. And then I didn't come back to it until many years later because I never really put the picture together of how can I go from being an entrepreneur to somebody who buys businesses. That was just something that like never crossed my mind. Years later, after I leave my education business and I start this venture firm, I go to business school. I never intended to go to business school. It wasn't part of my plan, but I was in between. I had just left my company. I didn't really know what I wanted to work on next. My friend was in business school. He said, hey, you should come here. You should check it out. Come to school. Maybe you'll be able to like figure out your next business or meet your next business partner. So that's exactly what I did. And for the first time ever, I was surrounded by people that were in the industry of buying businesses, right? I went to UC Santa Barbara for undergrad. That is not a feeder school for investment banking or M&A. It's not an Ivy League. It's not a Stanford, et cetera. But this time I was actually surrounded by people who had been investment bankers and private equity people for 5 years now. So we're just sitting around the table talking about, each other's companies and kind of what we've learned. And they're telling me about the deals that they've done and how they've structured them and how they finance them. And for me, it was like a light bulb that went off. I thought to myself, oh, wow, like I've read this book about Warren many years ago. I've always respected him. I'm an entrepreneur, but I don't really love the early days of entrepreneurship, of building a business. I love cash flow. Like I was getting a huge kick out of the clinical trial business. How do I put all these things together and step into this role? And that's just when me and my business partner started talking. I was sharing everything that I was learning on campus with him, and he started thinking, okay, like we should do a Berkshire Hathaway. He really like came to me with that idea. He said, why don't we do the modern version of Berkshire? In the early days, we'll do a private C corporation, and we'll go out, we'll buy cash flowing businesses. We'll use that cash flow to go out and buy more companies, and then we'll just compound over the years. And that is exactly what we do today. We've iterated a little bit on the types of businesses that we buy, but that is at its core what we do. We buy great cash flowing companies or companies that can cash flow, and then we use that, we collect that money on our balance sheet, and then we use that to go out and buy other businesses.
And did you funnel that money from the trial business, or did you go raise from external investors?
So the clinical trial business, I ended up selling right as we were starting this. Basically, I had these two parallel paths that I could take, Enduring Ventures and my clinical trial business. And the Enduring Ventures path had a few really exciting things behind it. One, I could work with my business partner, Xavier, who I'd known for many years, and I really respected him. Two, it seemed like something I could do forever as opposed to the clinical trial business, which maybe I would sell after a few years. And three, it just seemed more exciting for my personality, right? It let me work on a variety of different businesses over time as opposed to just focus on this one business, grow it, sell it, and then move on.
So tell me more about the playbook for the holdco. I feel like if every young person just kind of followed the winds of Twitter as their inspiration, they'd all want to be building holdcos now instead of venture-backed startups. I mean, there must be something insanely amazing about it, especially from someone who runs it, who can give us that insight. I mean, and then I'd also love to learn like what revenue ranges you're looking at in businesses, maybe a few examples of the firms, of companies that you've bought, what industries they're in, how much revenue they're doing. And kind of how long it took you to go from the first acquisition to the next. So kind of a broad question, but I'd love to get like really deep and technical on like the playbook and then kind of a evolution from the years of gradually getting to 20 under management.
Sure. So let's start with some of your latter questions, and then we'll move backwards over time. We focus on primarily two categories of businesses. These are our pillars. Category one is we focus on businesses that generate healthy free cash flow in the order of 3 to 10 million. You asked me about size. So revenue, 10 million and up, it can be 10 to 150 or 200 million of revenue, but cash flow of 3 to 10 million in size. These are good, healthy businesses that have been around for at least 10 years. Sometimes they're blue collar businesses, sometimes they're B2B service businesses. Today, we own a variety of different companies under there. We own an international recruiting firm. We own the leading book publishing business called Scribe Media. We own a hotel management business. So we manage hotels for people that own hotels that are between 10 to 100 keys, very profitably. Means number of doors. So that's one category of business, right? We also own HVAC, plumbing, and a few others as well. Service, that is, for people. The second category is special situations and turnarounds and fallen angels is what we call them. So the category here is businesses that are either unprofitable, so EBITDA negative, or they are barely profitable or a little bit profitable with a lender problem. So this is like where we are in the problem-solving game, basically. So there are businesses out there that, for example, have raised $50 million of venture capital. This is a business that we bought, right? It was losing 10 million it was net burning 10 million per year. It was not going to be the next venture capital outcome, right? So VCs gave up on it. At some point they said, hey, this is a good business. This is not going to be a great business. At that point, the founders are at a crosshair, right? They're in a difficult moment, meaning like, they are sitting behind this massive pref stack of their investors. They are no longer seeing the big exit, so they're feeling demoralized. Maybe they've been working on the business for 10 years, and they don't really see a way out. So VCs don't have a solution for them. Founders don't have a solution for them. And private equity is not really a buyer for them because it's not a profitable business, or it's not a healthy, profitable business, right? So we can come in, because we're tech founders and we have this experience and we have a team around this, we can come in and solve that problem. We'll come in, we'll negotiate a good outcome for the VCs. If there's a lender involved, we'll figure out a good outcome for them. Sometimes that means us paying off the lender. We'll figure out a good outcome for the founders, and we can come in and actually buy that business and run it profitably, right? Again, we're not in the venture game, so when we're coming into those situations, it's in order to quickly turn that business into a business that is profitable as opposed to one that is shooting for the moon. In that category are also carve-outs, right? So we are working with public companies or large businesses that acquired a company that's no longer core to what they do. It could be making money, it could be losing money, but they just need to get it off of they just can't be spending any more time on it. So they need to sell it, they need to give it to somebody else to take care of, and we'll parachute in and solve those problems for those groups as well.
What does that negotiation process look like, Sieva? So like, say, you're going outbound. So this is not a company coming to you. You find this business, you're like, I want to go buy this. What does that process look like? How are you getting in touch with these people? How do you start those conversations? And ultimately, like, what does that timeline even look like? Is that a 2-month game? Is that a year-long game? Like, what does that look like?
Yeah, we've been doing this for a little while now. So people recognize our name. Obviously, you mentioned Twitter earlier. We have built audiences on Twitter and X now, on LinkedIn. I have a pretty large newsletter. So we've been talking about this motion, these two categories of businesses for the last 5 years, basically. So now what happens is, in this distressed and special situation category, what happens is a VC may reach out to us, or an angel may reach out to us, or a founder may reach out to us. They may say, hey, like, I feel stuck, right? I see that I'm not going to be able to raise the capital in order to get myself to be a huge business. My business is losing money, and I feel like I'm losing hope here, right? I spent many years working on this. Like, can you guys help me solve this problem? Or what are some ideas that you have? And sometimes we're just a sounding board. For many founders, they'll just call me and I'll get on the phone with them and just give them guidance around like term sheets they're getting or kind of advice that they're getting from other investors. And sometimes, we can be a good partner. We can kind of come in and help support them. And sometimes, and in some occasions, the founder wants to stick around, continue running the business. They really believe in it. And in other occasions, the founder is tired and kind of wants to move on. And in that situation, our team will parachute in, build a team that needs to run this business, and then everybody can kind of go their separate ways with their best outcome.
So, Sieva, it sounds like you do a lot of kind of insertion work, right? Like you're you're not just kind of like this overarching holdco. Like you actually are going into these businesses and providing like assistance. What is it, like legacy planning, probably recruiting, like things like that. Um, how do you even like build a team around that, and how do you even split time between all these different businesses to figure these kinds of things out? It sounds like a lot of different responsibilities, especially if you need to be a babysitter, you need to like get your hands dirty instead of just buying them and being like, okay, moving on to the next thing.
Yeah. So actually, when we started this journey, and we bought our first business, which was upcouncil.com, it was one of these special situation businesses, right? They had raised $30 million. They were no longer growing as fast as their VCs wanted them to. So the VC spigot dried up, and they shopped the business, and they really weren't able to sell it for the price that they wanted to. So what we did is we came in, we'd been users of the product. We came in, we reached out to the founders, and we said, hey, we'd love to buy this business. Let's find a good outcome for you guys and your investors. And we were able to do that in the matter of like a week or two. We had to move pretty quickly for that one. For that business, I was the CFO, my business partner was the CEO, and we hired a head of product until we were able to build up a team in order to replace ourselves. That was just the that was the situation we were in. We were just starting from scratch. Today, we have a team. We have 5 investment professionals. We have one person who focuses on consumer brands and retail. We have one person who focuses on tech and tech services. We have another person who's actually out there buying boutique hotels and motels. And we have a tech turnaround team. So when we buy one of these businesses under the tech portfolio, we have a group that can parachute in if they need to, right? Either they can be a support function to the current CEO, or they can come in and really be the leadership team until they get things in order, until they get the team moving.
And those people are just always on staff, just like ready to drop in, like a SWAT.
They are, yeah. They're kind of they cycle in between the different companies. They're supporting the different companies. They're really like a SWAT team. They parachute in when they need to do stuff. It'll take them 3 months, sometimes 6 months to really get a company fixed up in the way that we need to be running it, because there's a lot that needs to happen from going either from a VC-backed company or from a carve-out to like a functioning, self-sustaining business. It's a ton of work, and they're incredibly capable executives, right? It's not easy to do.
What are the subtle signs of this is going to be a great business versus maybe the other side of that, which are signs that this is not going to be a really, really strong business when you're evaluating these opportunities, right? Because I think like the clear ones are like the company's financial performance, the operating team, but like what are those subtle cues that can really be make or break it for the company if you don't figure those out like relatively quickly?
I think at this point in our investment structure, the most important philosophy that we have is around not losing money. So every single decision is predicated on this idea. And it sounds really simple, right? It's just like, yeah, just invest in things that return your money. But at its core, there's a lot of like trickle down effects that happen when that is your core philosophy, right? And that is a very different philosophy than my days in venture capital. Me and my business partner come from this. So earlier when you were asking, what is the mindset shift? Part of it is this mindset shift of don't lose money, right? In VC, you can make 10 bets and 9 of them can go to zero, and that's perfectly normal. And one of them will return the whole portfolio. In private equity, or what we do, the main goal is that every single time you deploy equity, you have a high degree of certainty. So with 100% certainty, you're going to get at least your money back. If you put in $1,000, you're getting $1,000 back. And then if that is true across your portfolio, let's say you buy 5 businesses, 1 or 2 of those businesses are going to outperform in a way that you didn't expect. So they may do 2 times, 3 times, 10 times your money. And that is how you start bending the curve and really compounding value in private equity, in specifically holding companies, right? And one learning that I've actually had over the years, people talk about Bill Ackman, people talk about Warren Buffett, they talk about Charlie Munger being these incredible holding company investors. Those are all extremely true, but they are not oracles, right? They cannot look at a business, and this has just been a learning. Like I believed that they were oracles 10 years ago because they call Warren the Oracle of Omaha. But what I've actually learned is that over the years, they get incredibly good at making better investing decisions, right? They're less likely to make a bad investing decision, but they also never know when their investments are going to outperform. So in any given year, they make 5 investments that they really believe in. The intent for them is to not lose money, right? They want to make their money back. They want to invest in a way where they have a high degree of certainty of at least getting their money back and hopefully 2 or 3xing their money over some period of time. But every once in a while, they'll catch a tiger by its tail, right? Years ago, Buffett invested in Apple Computer. It wasn't their biggest investment. They could have backed up the truck and made a much bigger investment. I think they invested $500 million, which wasn't that big of a check for them. In that same year, they made many investments of that size or larger, but it just turned out that Apple was by far their best performing company in these recent years, right? It made up something like 20% of their entire holdings until they started selling down a few weeks ago. So I say that to really like emphasize this point that if you're out there buying, or certainly like when we're out there buying, we don't believe ourselves to be the smartest people in the world. The most important underwriting for us is, how do we ensure that if I'm going to put in $5 million into this business with a really high degree of certainty, I'm going to get that money back? Because if I get that money back, I can reinvest it somewhere else. If I don't get that money back, that's a loss in my portfolio, and I've interrupted the compounding of the overall portfolio, right?
Totally. I mean, it's so interesting to me because like I think that, you know, people will listen to this podcast and they'll say like, I totally agree with Sieva. That makes a lot of sense. I feel like I can go do this. But then the biggest question becomes, they don't have access to capital, right? It's capital and deal flow, I imagine, would be their 2 biggest issues. And so the thing that I've been hearing a lot lately is seller financing, right? Like you can kind of seller finance your way into a deal. You can be scrappy and, you know, find a win-win situation for both the seller and yourself. And that's maybe a great way to structure these deals. Do you have much experience around that? And what has kind of been like maybe some learnings if you have done things like that?
Yeah, when we started in the small business world, right? We were buying businesses that were like 500,000 to $1.5 million of free cash. That's considered small businesses. Private equity doesn't even look at that. Since then, we've grown a little bit. As I mentioned, we're looking at the 3 to 10 million earnings in size. So if you're looking at small businesses, there's a variety of different ways to finance it. One is seller notes, as you said, and seller notes are really common. The reality of the situation is that if you have a business that's doing 500K to $1 million of profit, there's not a lot of buyers for you out there. There's just not a lot of competition, right? It's a risky business. It's a difficult business. There's usually not a good management team in place yet at that size. So somebody who's buying the business is really just buying a job for the early years until they can grow the business enough to pay for an expensive management team who can then run that business. So because of that, because there's not a lot of competition, seller notes are very, very common, right? You can talk to an owner and say, look, like I understand you want $1.5 million for your business doing $500,000 per year, but there's a lot of risk in this business, right? Like if you leave, maybe the key relationships leave. Or if you leave, maybe the key 2 employees want to leave. And you really don't know. Obviously, you should do due diligence, but you don't know all the range of risk that you're taking. So asking the owner to share some of the risk on the back end is a totally reasonable ask. And I've seen people ask for seller notes that are 10%, 30%, 50%, and sometimes even 90% of the deal price. Like we've received seller notes on deals that are 90% of the deal, right? The owner in that situation wants to get a little bit of money up front, so they're de-risked, but they believe in their business. And for tax reasons, and they also want interest on the loan, they're comfortable getting paid over time, okay? And ultimately, like the assets of the business are backstopped by the seller note. So if for some reason we miss a payment to them, they get everything that we've paid them today and the business back, which is not a bad deal for some owners. But there's of course some risk. Also, by the way, if you are somebody with not a lot of assets currently, then there's this wonderful program that is hosted by the U.S. government called the SBA 7A loan. And there's real risk to this program because you have to personally guarantee it, meaning like if you don't pay the loan, the bank may come after your personal assets. But if you don't have a lot of assets, then it may be a risk reward that you're willing to do, right? Risk reward trade-off. You can say, okay, look, like I have $50,000 or $100,000 in the bank that I've saved up my whole life. Maybe just 50,000, and I want to go buy this business that does $1 million of free cash. Well, if you are successful and you're able to pay off that loan one day, you're going to be a millionaire, right? You went from having 50,000 in your bank to being a millionaire. If it doesn't work, hopefully that doesn't happen. There's not a high failure rate on SBA 7 loans, just 3 to 7%, I think is what I've read.
Wow.
Yeah, it's pretty low. So statistically, like your probability of not getting your PG called seems to be pretty low. But yeah, like I said, even if your PG does get called, you have $50,000 in the bank. There's bankruptcy law in the U.S. that'll protect you, right? It's not going to ruin your life. It's just going to make things a little bit harder for you for the foreseeable future. I don't recommend it. Obviously, don't recommend bankruptcy, but I do recommend the SBA 7A for people that want to transform their wealth. Just be really, really careful in the types of businesses you buy, right? Don't just buy any old company that you think is exciting and that you get wooed into buying, right? There's a lot of really bad businesses out there that shouldn't be bought. Like, do your research, spend years studying this stuff, and then go out and proceed carefully.
What are some businesses that someone on the outside of like the holdco strategy playbook would think are like, oh, those are great, those are super smart, you should buy those, but maybe not? Like, what are some misconceptions from the outside on your business when it comes to like the types of businesses that would be good to hold over the long term? Like, what does Buffett does, like insurance companies, and I guess he did Apple as kind of a tech investment, but it's like, there's all these like kind of quirky things in there too that aren't really sexy in any way. So I don't know. What are the types of businesses that are ideal?
Buffett talks a lot about margin safety, right? And having a moat around your businesses. And one of the best moats you can have around your business is owning a brand, right? Like Coca-Cola. Coca-Cola sells sugar water, right? Sugar water should sell for $1 a bottle or something, $1, whatever you pay, like 50 cents at the store for a bottle. But it doesn't, right? A can of Coca-Cola costs like $2 at the store, and that is their margin, right? So maybe it costs them the same amount as it would to make water with sugar, but they're commanding a much higher premium because they have this wonderful brand. That is why he invested in Apple, right? Apple is one of the most wonderful brands in the world. I think I don't remember it, I'm sure I'll butcher the story, but I think he was giving a speech to a group of college students, and he asked, like, if you owned a Toyota and I came to you and I said, I'll give you more money for your Toyota than it's actually worth, would you sell it to me? And the answer was like, would you give up Toyota forever, right? If I said like, hey, like I'll pay you $15,000, you have to buy Nissans or anything that's not a Toyota, but you can't ever buy a Toyota again. And most of the class raised their hand and they said yes. And then he asked the same question about Apple iPhone. He said, right, like you guys own Apple iPhones. Who owns an Apple iPhone? I'll pay you guys $15,000 to never buy an Apple iPhone again. And how many people said yes? Very few, very, very few. People were not willing to make the trade-off. And he was going to give them cold hard cash, right? So that's like an example.
Great story.
That's an example of a world-class brand, right? Like, of course you want to own that. So the way we think about owning businesses in the holding company is, again, downstream from that concept, right? Like you need to have a moat. You need to be able to protect your margins, because if you can protect your margins, you can raise prices. As inflation is always going to go up, right? Inflation over the last few years has been extremely high. Over the next few years, hopefully it's going to be lower, but it's always going to be 2 to 4%, even if things are functioning correctly. What that means is the value of the dollar is getting depreciated over time, right? Something that was $1 in 1960 today is $10. So the value of the dollar is going down. The only way to combat that is to own assets, and specifically own cash flowing assets where you can raise prices to keep up or in excess of inflation over time, right? And there's a lot of businesses where you cannot do that, right? There's a lot of businesses that get destroyed by their competition. There's too much bidding happening. Labor is too expensive. The price of your goods is too expensive over time, and you lose your margin. So when we think about the types of businesses that we want to buy a business that has a brand, right? Even if it's a local brand. So we own this wonderful plumbing business that's extremely profitable. When inflation went up, they were able to raise their prices. They're able to raise their prices because they have excellent technicians, they have excellent reviews, they have a great reputation. People aren't really bidding their projects, right? They trust this business and they're saying, hey, I need you to solve my problem. It's a big problem. My sewer is leaking in my house, and my house is my biggest investment. So they are willing to pay what it takes in order to solve that problem with a high degree of confidence. That is like one example of brand and margin protection, right? So a lot of our investments are around that concept, right?
Well, the brand thing is interesting, right? Because you guys just bought Sheperd, and we can get into more details about that, but then you rebranded it to Somewhere. And so what was kind of some of the logic and rationale there? Because it felt like from the outside looking in, Sheperd was so popular, right? Like it was getting promoted everywhere. And like, if you thought about overseas, like VAs and such, like I feel like Sheperd was one of the top names that came to people's minds.
Sure. So this investment is somewhere.com now. They rebranded from a firm called Support Sheperd. What they do is they help American companies hire abroad, right? They will hire any type of role that you need. You need an engineer, do you need a salesperson, you need someone cold calling, or a manager, customer service person, any type of role that you can hire in the US, they're going to help you hire in Asia, South Africa, or Latin America. And usually it's going to be 70% less than the salary you would pay in the US. So what has happened over the last 10 years as tools like Zoom and Slack and email have become popularized is more and more people have become comfortable with this idea of remote, right? 10, 15 years ago when I first started my company, everybody was in office together. I was running one of the few remote organizations, and I was actually hiring abroad because I frankly just couldn't afford to pay people in California. So I was hiring people in Asia for that role. And what I had to do back then is I actually was like 22 years old. I had to get on an airplane. I had to fly to the Philippines. I had to find an office. I had to hire a lawyer. I had to hire an accountant, figure out all the local laws. Then I hired a recruiter, and then we started hiring people locally into that office. What Sheperd does for you is they have hundreds of recruiters in all of these different countries. So they have relationships with the universities and all of the best businesses. And when you post a job with them, they'll go out and they'll actually do that work. So you don't have to like do what I did. You don't have to fly to Asia. You don't have to fly to Colombia in order to find the best workers anymore. The reasons why we invested in the business are a fewfold. Number one, we really believe in the trend. Right? Like this is just a pendulum. This is a pendulum that is only swinging in one direction. More and more medium and large businesses are becoming comfortable hiring great people abroad. It's no longer just the admin hire. People are replacing their managers. They're replacing their senior managers with extremely talented people abroad. So I think that's just a general trend, and I like to invest in trends that are moving in our direction. The second piece is we invested and really backed Nick Huber, who's very active on social media. He's a little bit spicy on there. I don't always agree with the things he says, but he's an incredible entrepreneur. He's an incredible, kind, candid person in real life, which is maybe sometimes at odds with his Twitter persona. But he is driven, he has a vision for this business, and he has really helped it grow from being a small business where he was helping promote it to being a pretty sizable, wonderful business. And then, of course, the third piece of our investment philosophy that I mentioned earlier is never lose money, right? Again, this is a business that is extremely profitable, that we invested in at a fair price, and people aren't just going to stop recruiting abroad at some point. So I really, really believe in that company. I think it's wonderful. We've hired a bunch of people and actually just onboarded one controller overseas at like 70% cheaper. So we're paying him $50K now, but he would have been like $250K if I had to hire him in the US. You asked a little bit about the brand. So for years, this company was called Support Sheperd, I think 2-3 years, and they develop a pretty good brand around hiring abroad. The problem is nobody can spell Sheperd. I'm not going to make you do it right here, Simmy, but it's impossible. I've never been able to spell it correctly in the browser bar. So Nick and the team decided that they were going to find a word that they could buy the URL for and they could rebrand the company. So now it's called somewhere.com, and they paid a ton of money for that for that URL. We'll see if it was the right decision, but I do agree, like, it's impossible to spell the word Sheperd.
Definitely. That's so funny.
Isn't it
But
just
that's a really cool story.
Sheperd?
That's right.
There's
That's
probably
exactly
an A
it.
in there. Oh, wait,
There's like
no,
an
there's
H
not.
somewhere. Yeah.
That's crazy how the, in our globalized economy, right? The big trend was let's outsource factory work, let's outsource blue collar labor, right? Now we're seeing an outsourcing of white collar labor, which is super fascinating. And this is coming at the same time as like AI. So I don't know if anyone's going to be worse off than, the average middle class, American manager, right? Because you're either going to get your lunch money taken by somebody in the Philippines or, a robot. So
You just have to level up, like there's
Yeah.
still a lot of reasons to hire US staff, US based staff. There's still a ton of companies that are doing a return to office that want their employees in the office. So that is never going to go away. But there's hundreds of millions of jobs out there, and there's a larger proportion certainly that's being competed out to extremely talented people in Colombia, Argentina, the Philippines. And frankly, oftentimes these are people that were educated in the US, maybe were not able to get a job in the US because they couldn't get a visa to stay here, or they had to go home for family or other reasons. So you're getting a US trained person at a fraction of the price who speaks amazing English.
Yeah.
And when you're considering that trade-off, if you're a CFO or whatnot, and you're thinking to yourself, okay, like my business is doing $3 million of profit, but if I shipped, 10% of my rolls overseas or 20% of my rolls, this business could be doing $4 or $5 million of profit. What could you do with $1 to $2 million extra? And there's a lot of businesses that I'm seeing that are coming to that realization right now, or even businesses that aren't profitable and are break even that are saying, wait, like, why do I have such expensive staff in New York and San Francisco? Like, all of these roles can be done abroad, and I could be profitable.
How do you think about competition, though? Because the issue with it's a good issue, but, when you have a business that's really successful in kind of a more, I'm not going to say it's an emerging category, but it feels like there's new vibrant energy around it. Like, what somewhere.com has done. You see all of these people now trying to enter the space. They're all trying to build their own version of it. And from what I can tell, they're doing like pretty well. Like, they're small teams, but they're all doing like low seven figures and, probably in the aspect of a good lifestyle business, but it does seem like there's a lot of attention there. So how do you defend yourself, and what are some of the moat building activities that you think about?
Recruiting is one of those categories that has maybe the most 100 million revenue plus businesses in the US. You don't know about it. You've never heard about it, but there's like 10 businesses that do healthcare recruiting, and there's 10 businesses that do software recruiting, and there's 10 businesses that do executive there's hundreds of businesses that do executive recruiting.
Search firms just like make tons of money and like, it's just like Prince. Like Brett Adcock is like, he was talking to Sam. He does the robot company now, and he's like, yeah, if I wasn't doing robots, I'd be doing HR, like recruiting stuff. Like that's
his first business, Vettery, I think he sold for $100+ million that he bootstrapped. So we're talking about a huge need, right? Every business is in need. Not every business, needs an Instagram page. Not every business, not even every business employee needs a computer, for example, right? But like every business needs to hire employees, and it's constant. It never goes away. People are leaving, people are retiring, you're having to let people go, and you need to replace those people. You as the business owner are not a professional recruiter. You don't have enough time to source the world for the best talent. And every business owner who's been doing it for a while knows that talent is your most important lever. It is your most expensive line item in your P&L as well, right? So you're talking about the most important thing that is the most expensive, right? So if you can reduce your costs, or you can get incrementally better at hiring people, you're always going to pay someone to solve that problem for you. And that's why recruiting is such a good business, and it has a huge gross margin, right? It's a very profitable business. It's a very profitable business as well. So I'm not, I don't think, when I'm in a category like this, I don't think too much about the competition, because if you have found the right product market fit, which Sheperd and Somewhere has done, right? Like people love it. Like I think like they're doing like thousands of recruits at a time, and they have like hundreds of recruiters that are doing it. Like this is a real business that has like really perfected the art of finding high quality talent internationally. There's just not a lot of firms that are set up in that way that can truly compete, that have both the recruiting teams with the connections and the marketing engine and the positioning and the branding to make it all work, right? And even if there are, like somewhere could be a multi-$100 million company, and there could be dozens and dozens of others. So it's just a good business category that we're fond of with a good team behind it. So it's not like a VC type business where it's winner take all.
Yeah, that's crazy. Simmy,
Yeah, I mean, no, I was going to say, like, taking that a step further, though, if you look more broader and we look at private equity, it feels like there's, again, a lot of interest. People want to go start PE firms. They're going and raising a lot of money for them. And, like, when you look at, like, VC as an analogy, right, it feels like there's not enough good deals. And so when they do find a good deal, they just, like, there's this influx of cash that happens, right? And so, like, even though that was a great business, they've effectively, like, they're not going to be making a whole lot of money. How do you think about that in the lens of private equity, right? Like, if, again, people are more disciplined here when it comes to investing, buying these businesses, but still, if there's a lot of interest, how do you kind of defend yourself and make sure you're still getting access and you're not overpaying for stuff? Is that just doing less deals? Is that just trying to build more of a content advantage? Like, what does that look like?
Do you guys watch Survivor, the show?
Simmy loves that.
I love Survivor. Yeah.
Great. I have just gotten into it with my wife. I promise you this is relevant. It's just making me, you just triggered a thought for me. So we're watching Survivor yesterday, and they go through the auction. Some people know know Survivor, some people don't. But basically they're on an island, they're starving, there's an auction. Simmy, you know exactly what I'm talking about. Everybody gets $500, right? There's 10 people that get $500, and the host will put items on the table. Sometimes it's a cheeseburger. Again, remember, these people are starving. Sometimes it's an advantage, right? Like you can get immunity from getting voted off the island, which is extremely important in the game. And there's 10 people. Usually there's only 8 items that he's auctioning off. You don't know what he's going to auction off. And so people are bidding on these items that they're really excited about in the moment. And what I saw yesterday was there's 3 people bidding on the advantage. 2 of them put up $500. The first one missed out entirely. And those 2 that put up the $500, which is all their money, that's what it is. It's all their money. They put up all their money for this advantage. The 2, they basically had to Rochambeau to figure out who actually won the advantage. That is what venture capital feels like to me sometimes, right? There's 3 people at the table. They're extremely excited about this thing, and they're going to put all their money in, and then they're going to have to kind of get lucky in order to win the deal, right? There's a lot of good, and then there's luck involved as well. Private equity is not like that in such a way because it's not a finite amount of businesses, right? There's only going to be one Google per year. There's only going to be one Facebook per year, maybe a few businesses that are big enough to be venture scale. And that means there's hundreds of firms that are competing for these very few venture scale outcomes. I'm exaggerating. It's not really one. Maybe it's like a dozen or so. But there's hundreds of firms competing for like a dozen companies, basically, that are going to transform and that are really going to transform their fund, that is. In private equity, or what we do, you don't need that, right? You can make life-changing money by buying just one wonderful business. You can buy one wonderful business and transform your life and the life of your family forever, right? You buy a business that generates $1 million of free cash, or maybe it does $500K, you grow it to $1 million. If it predictably does $1 million of free cash for you for 15 years, that's a beautiful outcome, right? You made $10 million. Hopefully you invested some in the S&P 500. You retire with $10 to $20 million in the bank account. You lived a wonderful, wonderful life. That is very, very different than venture capital. So in private equity, there, especially like small business, medium business, private equity, there's millions of businesses you can buy. Again, I said you shouldn't buy all of them. Maybe 70, 80% are not great businesses to buy. But if you narrow it down, there's still hundreds of thousands of businesses you can buy, and there are not 100,000 private equity people searching for those businesses. So you can see that the return dynamics are likely to be better. The probability of a successful outcome is likely to be better. And frankly, I prefer to be playing a game where the probability of the outcome is much better skewed in my favor, right? I was never going to be a top 10 venture capitalist, top 10% venture capitalist. That is what you need to be to have a great VC career. That's just not me. I didn't go to Stanford undergrad. I wasn't smart enough. I'm not networked enough. It wasn't going to happen. I'd get lucky sometimes, and I did get lucky sometimes. But in private equity, I can play my game, and I want to play my game when I'm doing something for the rest of my life.
Sieva, thanks so much for your time. I think we'll wrap it up there unless we have anything else. But it's super cool what you've built. Sounds like you're going to build like a pretty big company one day. And it's not like it's not already big. I assume it's already,
I think they're already crushing.
Yeah, $100 million plus, but
Well, I appreciate you guys having me on. This was a ton of fun. Thank you.
Yeah. And for anyone who's listening and wants to go check out Sieva, we'll put all of his info in the show notes, but that wraps up another episode of Our Future Podcast. Stay frosty.
Stay frosty, everybody. Follow Sieva on Twitter. He's even more handsome in real life.